You know, usually when we talk about a medical diagnosis, there's this expectation of precision.
Hey, it's almost like engineering.
Yeah, exactly. You break your arm, the x-ray shows that jagged white line, and the doctor just points and says, you know, there it is, that's the problem.
It's binary. Broken or not broken. It's comforting, I mean, because we like things to be visible and easily categorized.
Yeah, but then you step into the world of macroeconomic policy,
Yeah.
specifically monetary economics in a developing nation like India. And suddenly that x-ray machine is, well, it's completely unreliable.
It's a very murky diagnostic landscape.
Incredibly murky. And if you are out there right now studying for the GE-04 Paper 4, you know exactly what murky waters I'm talking about.
We see you out there at DSE, JNU, just, buried in your revision.
We really do. And
Yeah.
we've built this deep dive strictly for you.
We have a massive stack of sources today. We're talking past year questions from 2010 all the way to 2025, official model answers, and actual RBI policy frameworks.
And the objective today is to really cut through that academic noise. We want to map out the complex, often messy institutional implementation of India's monetary economics.
Right, because theory is one thing, but practice is another.
Exactly. And just to be clear, we are strictly staying within the boundaries of the Indian institutional framework today.
So we aren't going to rederive ISLM model.
No ISLM today. We won't get bogged down in pure conceptual theory because you've got other materials for that. This is about how the plumbing actually works in the real world.
How the money actually flows, where the pipes leak, and why the valves sometimes get stuck.
Right. And to kick us off, I was looking through your GE-04 exam's specific focus areas. There is this classic 2025 IES question prompt.
Oh, the Friedman one.
Yes, it brings up Milton Friedman's famous assertion that, inflation is always and everywhere a monetary phenomenon.
It's a great quote.
It is. But then, right next to it, the exam pairs it with a question on the RBI's inflation targeting framework. And I thought, okay, let's unpack this.
Because on a chalkboard, Friedman's theory is elegant. It's this neat little equation.
But the actual institutional plumbing in India.
It is definitely not a neat equation. It's incredibly complex.
So if we want to understand inflation in India, and whether it truly is just a monetary phenomenon, where do we start?
We first have to understand the architect trying to control it. We have to look at the Reserve Bank of India itself.
And specifically how drastically it has transformed over the years, right? Because the RBI of today is absolutely not the RBI of 40 years ago.
Not at all. If you go back to the pre-1991 era, during the planned economy framework, the RBI wasn't an independent central bank in the modern sense.
What was it then?
It was essentially an instrument of state-directed credit allocation. It was all about directed lending, administered interest rates, and just incredibly high reserve requirements.
Like how high are we talking?
Well, the statutory liquidity ratio, the SLR, was pushed up around 38.5%. And the cash reserve ratio, the CRR, peaked at 15%.
Wait, 38.5 plus 15. That means over half of every single rupee deposited in a bank was essentially locked up or forcefully directed by the state.
Precisely. It was an era of total fiscal dominance.
Wow.
Yeah, the government ran massive deficits, and the RBI functioned more as a fiscal agent to mobilize resources to fund those deficits.
Rather than like an independent entity managing price stability.
Exactly. But post-1991, with the liberalization reforms, we see a fundamental transformation.
The chains come off.
Right. Interest rates are deregulated, reserve requirements are drastically brought down to free up capital, and they introduce market-based tools.
Which really sets the stage for what is arguably the most important structural shift for this exam.
The 2016 framework.
Yes, the flexible inflation targeting framework, the FIT. I mean, this is huge.
It's a complete watershed moment in Indian monetary history. Before this, the RBI had what they called a multiple indicator approach.
Which means they were juggling a lot of balls.
Too many. They were trying to balance inflation, growth, exchange rates, and financial stability all at once.
That sounds like trying to drive a car while looking at 10 different speedometers.
That's a perfect analogy. You just end up crashing. So in 2016, following the Urjit Patel Committee recommendations, the RBI Act was formally amended.
They finally gave the central bank a statutory mandate.
Yes, and the mandate became incredibly clear. Maintain Consumer Price Index, or CPI, inflation at 4%.
With a little bit of wiggle room, right?
Right, a tolerance band of plus or minus 2%. So legally keeping it between 2% and 6%.
And to actually steer the ship, they created a new group, the Monetary Policy Committee, the MPC.
Yes, the MPC is a 6-member committee. You need to know this structure for the exam.
Break it down for us.
3 members are from the RBI, including the governor who acts as the chairperson, and the other 3 are external domain experts nominated by the government of India.
So it's balanced. How do they actually make decisions?
By a majority vote, and the governor holds a casting vote in the event of a tie.
But there's a real accountability mechanism built into this, right? It's not just a target on a piece of paper that they can just, shrug off if they miss it.
Oh no, the legal accountability is what gives the whole FIT framework its teeth.
What happens if they mess up?
If the MPC fails to maintain inflation within that 2% to 6% band for 3 consecutive quarters, they are in trouble.
3 quarters, so 9 months of missing the target.
Right. The RBI is then legally required to submit an explanatory report to the central government.
Like a report card explaining why they failed.
Exactly. They have to detail exactly why they missed it, what remedial actions they are taking right now, and provide an estimate of when inflation will actually return to the target.
So what does this all mean? It seems like this structure is designed to anchor expectations.
That's exactly the phrase you want to use on the exam. Anchoring inflation expectations.
Because if businesses and consumers genuinely believe the RBI will force inflation back to 4%.
Then they negotiate their wages based on that.
Right. And they set their prices based on that 4% expectation. It becomes a self-fulfilling prophecy.
It gives the RBI tremendous credibility. It legally prioritizes price stability. But, and your GE-04 syllabus really emphasizes this, the word flexible is doing a lot of heavy lifting here.
Flexible inflation targeting. Why flexible?
Because they have to keep growth in mind. This is the classic Phillips curve trade-off in action.
Right, the trade-off between inflation and unemployment.
Exactly. If they hike interest rates too aggressively to just crush inflation, they risk stifling economic growth entirely and causing massive unemployment.
It's like steering a massive cargo ship with a relatively small rudder. They set a dial in Mumbai, and months later, it's supposed to change the price of tomatoes in a local market in Punjab.
It's a daunting task. And to understand how they actually attempt it, we need to understand the material they're working with.
Right. Before we get into the actual tools, we need to talk about money itself.
The exam demands a very solid grasp of monetary aggregates.
So let's break down M0 through M4. Let's build the plumbing.
This is the foundation. Let's start at the absolute source, M0.
M0.
Yes. This is reserve money. It's also known as high-powered money, or the monetary base.
What's actually in it?
It consists of currency in circulation, plus the deposits that commercial banks hold at the RBI.
Okay, so this is the money that the central bank directly creates and totally controls.
Precisely. And then we move up to M1, which is often called narrow money.
Narrow money. What does that add?
M1 is currency with the public, plus demand deposits in the banking system, like your checking accounts, plus other deposits with the RBI.
So it's highly liquid. I can spend it today.
Very liquid. Then you have M2, which is simply M1 plus savings deposits with post office savings banks.
Okay, post office savings are big in India, but the big one, the one the RBI really watches for policy decisions, is M3, right? Broad money.
Yes, M3 is the critical aggregate. You have to know M3. It equals M1 plus time deposits with the banking system.
Time deposits, like fixed deposits.
Exactly. Fixed deposits are a massive, massive pool of capital in India. So M3 represents the total stock of money available in the economy that can actually fuel aggregate demand.
Got it. And just to round it out, what is M4?
M4 is just M3 plus all deposits with post office savings organizations. But M3 is the star of the show.
Okay, so here's my question. How does M0, the high-powered money created by the RBI, turn into M3, the broad money in the entire economy?
That magical transformation happens through the money multiplier. And it's driven entirely by commercial banks.
Walk us through the mechanics of that.
Okay, imagine the RBI injects M0 into the system, say 100 rupees. That 100 rupees lands in a commercial bank.
Okay.
The bank is legally required to keep a small fraction of that as reserves, right? But they lend out the rest.
Let's say they lend it to me.
Right. You take that loan, you go buy a bicycle, and the bicycle seller takes your money and deposits it back into another bank.
And then that new bank keeps a fraction and lends out the rest again.
Exactly. This continuous looping cycle of lending and depositing multiplies the initial high-powered money into a much, much larger broad money supply. That's M3.
So the commercial banks are essentially co-creators of money alongside the RBI.
They absolutely are, which means the RBI's tools are primarily designed to influence how aggressively those banks execute that multiplier process.
Okay, let's open up the RBI's toolkit. The exam demands that you don't just know the definitions of these instruments, but exactly how they work mechanically on the balance sheets.
No purely theoretical answers here. You need the mechanics.
Let's start with the primary policy rate, the repo rate. What is it, and how does it work?
Repo stands for repurchase agreement. Here's the balance sheet effect. Imagine a commercial bank faces a short-term liquidity mismatch. They need funds today.
Okay.
They go to the RBI's discount window. To get cash, the bank pledges approved government securities G-SECs as collateral.
And they sign an agreement to buy them back.
Yes, they sign an agreement to repurchase them at a slightly higher price a few days later. That price difference, that interest, is the repo rate.
So the RBI takes the G-SECs and hands the bank cash.
Specifically, the RBI credits the commercial bank's reserve account. This instantly increases the bank's high-powered money reserves.
And what does the bank do with those extra reserves?
Because the bank now have a larger pool of reserves, it can aggressively expand its lending portfolio. When they lend more to consumers and businesses, they create new deposits.
Expanding M3.
Exactly. And with an increased supply of loanable funds in the broader market, the overall cost of borrowing market interest rates tends to fall.
That makes perfect sense. So what about the reverse repo rate? Is that just the RBI vacuuming up money?
That's a great way to picture it. If the RBI wants to fight inflation by absorbing excess liquidity, they use reverse repo.
How does the vacuum work?
They take funds from commercial banks and give them G-SECs in return. This drains reserves out of the banking system.
And with fewer reserves, the money multiplier contracts.
Right. Banks have a smaller pool of loanable funds. They have to reduce lending, M3 shrinks, and market interest rates go up.
Okay, those are the market-based rate tools. But the RBI also has strict quantitative reserve requirements, right? The blunt force tools.
Yes. Let's talk about the CRR, the cash reserve ratio. This is a very direct, blunt instrument.
What does it actually mandate?
The CRR mandates that a specific percentage of a bank's total deposits, technically their net demand and time liabilities, or NDTL.
NDTL, right?
Yes. That percentage must be locked up in pure cash and kept physically or electronically with the RBI.
And crucially, the banks earn absolutely zero interest on this cash, correct?
Zero. Nothing. It is completely immobilized capital.
Wow.
So if the RBI decides to raise the CRR from, say, 4% to 4.5%, it instantly confiscates a massive portion of the banking sector's loanable funds.
Because that money legally cannot be lent out.
Exactly. By removing this cash from the base, it directly shrinks the credit multiplier. The bank physically cannot create as many new loans. It forcibly contracts M3.
Okay. And then there's the SLR, the statutory liquidity ratio. Similar vibe, but different assets.
Right. While CRR is pure cash locked at the RBI, the SLR forces banks to park a percentage of their NDTL in safe, highly liquid assets.
Like what?
Primarily approved government securities, G-SECs, and sometimes gold. But the key difference is they keep these assets on their own balance sheets, and they do earn interest on those G-SECs.
But the macroeconomic effect is still restrictive, right? Because they still can't lend it to me for a car.
Exactly. By forcing banks to hold these specific assets, it restricts the pool of funds available for commercial credit expansion.
It's like a forced savings account.
Yes, and it effectively creates a captive market for government debt, forcing banks to finance the fiscal deficit rather than lending to the private sector.
Right. Okay, next up in the toolkit, OMOs, open market operations. How does this actually play out in real time?
If the RBI decides to inject permanent liquidity via an OMO, it buys G-SECs outright from the open market, usually from commercial banks or primary dealers.
And how do they pay for them? They don't just hand over briefcases of cash.
No, they pay by simply typing a keystroke and directly crediting the reserve accounts those commercial banks hold at the RBI.
They are literally creating high-powered money out of thin air.
That's fiat currency for you.
Yeah.
This directly increases M0.
Okay.
So the banks now find themselves sitting on these extra non-interest-bearing reserves. And to maximize their profits, they must lend out these extra reserves to the public.
Which kicks off the multiplier again.
Exactly. As they lend, they create new demand deposits. M3 rises and interest rates fall.
And if the RBI sells G-SECs?
The exact reverse. They debit the bank's reserve accounts, M0 shrinks, lending contracts, and rates rise.
Okay, now there are two more tools that create what's called the LAF corridor.
The Liquidity Adjustment Facility corridor, very important for the exam.
Right. There's a ceiling and a floor to contain overnight interest rate volatility. Let's start with the ceiling. The MSF. What is that?
The Marginal Standing Facility. Think of this as the emergency penalty window. It acts as the absolute ceiling for short-term interbank rates.
Emergency. Like, When would a bank use it?
If a bank is desperate for overnight funds, perhaps they miscalculated their liquidity needs for the day, and they have already exhausted their normal repo borrowing limits, they can go to the MSF.
But it comes at a steep price, I assume.
Yes, it costs them a penal rate, usually 25 basis points higher than the standard repo rate.
Gotcha.
But here's the vital mechanical distinction for the exam. Under normal repo, banks cannot use the GSECs they are holding to meet their SLR requirement as collateral.
Oh, because those are locked up for SLR.
Right. But under the MSF, because it's an emergency, banks are allowed to dip into their mandatory SLR quota to provide the collateral.
Oh, wow. So it's a true safety valve.
Exactly. It prevents overnight rates from spiking into the stratosphere, but that penal rate ensures banks only use it when they are truly desperate.
Okay, that's the ceiling. Now, what about the floor? This is a much newer tool introduced around 2022, the SDF.
Yes, the Standing Deposit Facility. This was a massive structural upgrade for the RBI. It acts as the firm floor of the LAF corridor.
What does it do?
It allows the RBI to absorb massive amounts of excess overnight liquidity from banks.
Wait, doesn't reverse repo already do that?
It does. But here is the key difference you must write down. With SDF, the RBI does not have to provide government securities as collateral to the banks.
Oh, I see. So previously under reverse repo, if the banking system was flooded with cash and the RBI wanted to soak it up, they were limited by how many GSECs they actually had in their own vault to hand over.
Precisely. During extraordinary events like post-demonetization or during the COVID pandemic where the banking system is just drowning in liquidity, the central bank might actually run out of collateral.
That's a huge constraint.
It is. The SDF removes that constraint entirely. The RBI can absorb infinite excess liquidity at the SDF rate, establishing a firm floor for interest rates without ever depleting their own stock of securities.
Okay, let's take a breath and step back. We've got the architect, the MPC, we've got the aggregates, M0 through M3, we've got the toolkit, repo, CRR, OMOs, the LAF corridor.
Levers are clearly defined.
But pulling these levers in an office in Mumbai doesn't instantly fix the economy across the entire subcontinent. We need to look at the plumbing that actually carries these policy changes out to the real world.
This brings us to the monetary transmission mechanism.
And this is where economic theory hits the brutal friction of reality. When the MPC changes the repo rate, how does that actually impact aggregate demand?
There are three main channels you need to understand. Let's start with the most direct one.
Okay. Say the RBI hikes the repo rate. How does that actually stop me, an average consumer, from buying a car or stop a factory from expanding?
That happens primarily through the bank lending channel. The RBI makes borrowing more expensive for commercial banks, right?
Yeah.
The banks, facing a higher cost of funds, simply pass that cost on to consumers. They raise their own lending rates, specifically their marginal cost of funds-based lending rate,
Right.
or MCLR.
The MCLR.
Yes. So when the interest rate on your auto loan goes up, you decide to delay buying that car. And the factory decides it's too expensive to borrow for a new assembly line.
So aggregate demand drops.
Exactly, which cools down inflation.
That makes intuitive sense. What about the second channel, the asset price channel?
When interest rates go up, the discount rate used by investors to value future corporate cash flows increases.
Okay, what does that mean in practical terms?
It depresses the valuations of equities and bonds. The stock market drops. Bond portfolios lose value.
So my retirement account shrinks.
Right. Households and businesses experience a negative wealth effect. Even if your actual monthly salary hasn't changed, you feel poorer looking at your investment accounts.
And because I feel poor, I don't go out to eat as much.
Exactly. You instinctively cut back on your discretionary consumption, which again reduces aggregate demand.
Makes sense. And the third one is the exchange rate channel, which connects us to the rest of the world.
Yes. If the RBI raises interest rates, Indian financial assets suddenly yield higher returns compared to assets in other countries.
So foreign investors want in.
Right. It attracts foreign portfolio investors. They bring in dollars to buy Indian bonds. But to do that, they have to sell dollars and buy rupees.
Which causes the rupee to appreciate in value.
Correct. And a stronger rupee changes the math for imports and exports.
How so?
A stronger rupee makes imported goods cheaper, which directly reduces imported inflation, say, on crude oil or electronics.
That sounds good for inflation.
It is, but the flip side is that it makes Indian exports more expensive and less competitive abroad. So export demand falls, which further slows down the domestic economy.
Okay, so in a textbook, those three channels flow perfectly. You pull the lever, the water flows through the pipes, the pressure changes. But in India,
In India, the transmission is highly, highly imperfect.
in fact, sometimes it feels like the RBI is just pushing on a string. Why is that?
This is a crucial area for the GE-04 paper. You absolutely have to explain this friction on the exam. First, there are significant time lags.
How long?
It takes an average of 6 to 8 months for a repo rate cut by the RBI to fully pass through to the actual MCLR rates offered by banks to consumers.
6 to 8 months. Why does it take so long?
Because a bank's cost of funds is largely determined by the interest it pays on its deposits. And deposit rates are incredibly sticky.
Meaning they don't change fast.
Right. If a bank has locked in millions of customers into fixed deposits at 7% for 2 years, they can't suddenly lower their lending rates just because the RBI cut the repo rate today.
Because their cost structure hasn't changed yet. They still have to pay out that 7%.
Exactly. So the plumbing has a massive delay built into it.
What else causes friction?
The sheer size of the informal economy. You cannot ignore this in India.
Yeah.
Nearly 40% of India's credit market is informal.
Give me an example.
Imagine a farmer in Uttar Pradesh. He doesn't go to the State Bank of India for a loan to buy seeds. He goes to a local RTIA, a commission agent, or a village moneylender.
And he's probably borrowing at an exorbitant rate, right? Say 24% annually.
At least. So if the RBI hikes the repo rate by 50 basis points in Mumbai, does that moneylender care?
Not at all.
Exactly. His capital isn't borrowed from the RBI discount window. He sets his rates based on local demand and default risk. So the farmer's rate stays exactly the same.
Wow. So a huge chunk of the agrarian and microenterprise economy simply bypasses the central bank's monetary policy transmission entirely?
The lever is pulled, but the farmer feels absolutely nothing.
That is a massive blind spot for policy. And a third major reason for imperfect transmission is risk aversion, right? The banks just refuse to lend.
Yes, leading to a classic liquidity trap scenario.
Walk me through a liquidity trap.
Imagine the RBI cuts of repo rate drastically to stimulate growth during a recession. They pump M0 into the system via OMOs. The banks have plenty of cheap reserves.
So they should be lending it out to create M3.
Right. But if the economy is struggling and the banks are terrified of defaults, they become severely risk-averse. They look at corporate borrowers and say, no, it's too risky.
So what do they do with all that cheap money?
Instead of lending to businesses, they just park their excess money in safe government bonds. The RBI is providing the liquidity, but the banks refuse to open the tap to the real economy.
So the liquidity is there, but you can't force the banks to lend it, pulling on a string.
Exactly.
Which naturally leads us to look at the institutions that actually make up this plumbing. Let's map out the banking structure and financial inclusion.
The formal structure includes scheduled commercial banks, or SCBs, but it's much wider than that.
Right, like regional rural banks, the RRBs.
Yes, and it's important to note for your exam that for regulatory and tax purposes, RRBs are often treated similarly to cooperative societies.
Oh, really?
Yeah, and they are required to maintain a capital to risk-weighted assets ratio, or SCRR, of 9%.
Good detail to remember. What else?
You also have newer, differentiated entities like small finance banks, catering to niche markets and unorganized sectors, and payment banks.
Payment banks are fascinating because they facilitate digital transactions and remittances, but they aren't allowed to issue traditional credit or loans, right?
Correct. They're pure transactional pipes. They don't create credit.
And all of this ties heavily into financial inclusion. The formal plumbing is actively trying to reach more households. We've seen massive state pushes here with the Jan Dhan Yohana and insurance schemes like PMJ-JBY and PMSBY.
And you really cannot view these just as social welfare schemes. That's a mistake. They are vital macroeconomic tools for monetary policy.
How so? Connect those dots for us.
Think about the mechanics. The Pradhan Mantri Jeevan Jyoti Bima Yojana is life insurance.
Yeah.
And the Suraksha Bima Yojana is accident insurance.
Right, very low premiums.
Yes, they automatically debit small premiums, say 436 or 20, directly from millions of Jan Dhan bank accounts every single year.
Okay.
To keep their insurance active, citizens must keep a minimum balance in the formal banking system.
Ah, so it stops them from withdrawing all their cash and stuffing it under a mattress.
Exactly. It reduces cash leakage. By bringing hundreds of millions of unbanked citizens into the formal financial system and incentivizing them to keep money in their accounts, you are structurally expanding the base upon which the money multiplier operates.
That's brilliant. Cash that used to sit in the informal sector is now a stable deposit base for commercial banks.
Right, allowing them to lend more long-term capital.
And it's all moving digitally now, expanding the formal net even further.
The digital public infrastructure is the modern plumbing.
Hmm.
UPI, NEFT, RTGS, these systems have drastically increased the velocity of money.
A rupee changes hands much faster now.
Exactly. And it's all overseen by the Payments Regulatory Board, the PRB, which acts as the apex body within the RBI to regulate these systems.
Okay, so that's the formal, visible plumbing. But what about the shadows? We have to talk about the non-banking financial companies, the NBFCs.
This brings up a critical vulnerability in the system. NBFCs are a massive part of India's credit delivery system.
Like for what kind of loans?
Vehicle finance, microfinance, real estate developer loans. They are huge. But they're called the shadow banking system because they operate outside the traditional regulatory boundaries of commercial banks.
What's the main difference? Why are they in the shadows?
Unlike commercial banks, NBFCs do not have to maintain those strict CRR and SLR reserves we talked about.
Wait, they don't have that mandatory buffer of cash locked up at the RBI?
No. And they don't primarily raise funds through traditional, sticky, retail savings deposits like a normal bank.
So where do they get their money to lend out?
They raise funds wholesale via the capital markets.
Hmm.
They issue commercial paper or non-convertible debentures.
Okay, so they borrow from the market to lend to consumers.
Exactly. Because they aren't bound by CRR, SLR, or direct repo-linked deposit rates, they effectively bypass traditional quantitative monetary policy tools. They create credit on their own terms.
Which is great for expanding credit reach to areas banks won't touch. But it creates a massive structural risk, doesn't it?
A huge risk. They borrow short-term from the money markets, but they lend long-term for things like infrastructure or real estate.
That's a classic asset-liability mismatch.
Exactly. Which brings us to the elephant in the room, the 2018 ILNFS crisis.
Oh, man. Infrastructure leasing and financial services. This is your prime case study for systemic risk in the shadow banking sector for the exam.
It's the perfect example. ILNFS was a massive, highly rated NBFC. But because of that asset-liability mismatch, when some of their long-term infrastructure projects stalled, they suddenly didn't have the cash flow to pay back the short-term commercial paper they had issued.
And so they defaulted.
They defaulted.
And because the financial system is so interconnected, the contagion was instantaneous, right?
It was terrifying. Mutual funds held huge amounts of ILNFS commercial paper. Commercial banks had lent heavily to them. When ILNFS defaulted, absolute panic spread.
Everybody froze.
Mutual funds completely stopped buying any NBFC debt. Because NBFCs couldn't roll over their short-term liabilities, they had to stop lending entirely. Credit to the real economy auto loans, housing loans, completely froze.
And here is the crucial macroeconomic takeaway for GE-04. This severe liquidity crunch happened despite the RBI maintaining a generally accommodative monetary stance at the time.
Exactly. The RBI had the repo rate at a reasonable level. They were trying to support growth. But their traditional levers were completely useless because the blockage wasn't in the commercial banks.
He was in the shadow plumbing.
Yes, where the RBI's tools have much less direct traction.
So ILNFS showed us how the shadow system can freeze. But even if the NBFCs were perfectly healthy, the traditional commercial banks were already hiding a massive rotting secret on their balance sheets.
Yes, they were.
Which brings us to the non-performing asset, or NPA, crisis.
This has been the defining structural challenge for Indian banking over the last decade. You have to know this inside and out.
Let's define it first. What exactly is an NPA?
An NPA is a loan where the borrower has failed to make interest or principal payments for 90 days.
90 days of silence, and it's officially bad.
Right. We look at two metrics. Gross NPAs, which is the total value of all these bad loans.
And the other is net NPAs.
Yes, net NPAs, which is the gross amount minus the provisions the bank has set aside from its profits to cover the expected losses.
Why are NPAs so destructive to the broader economy? I mean, a bad loan is bad for the bank, but why does it matter to everyone else?
Think about the balance sheet domino effect. When a bank has high NPAs, its profitability is crushed because it isn't earning interest on those massive loans.
But it still has to pay interest to the depositors who funded those loans.
Exactly.
Yeah.
Worse, the regulator forces the bank to set aside capital as provisions for those bad debts. This erodes the bank's capital adequacy.
And if their capital base shrinks.
They legally cannot lend. The credit multiplier breaks down entirely. The bad debt acts like a black hole, sucking in capital that could otherwise be lent out.
So the whole transmission mechanism fails.
Even if the RBI lowers the repo rate to 0%, a bank bogged down by NPAs will not extend new credit. They're focused entirely on survival and balance sheet repair.
Wait, if banks are legally required to maintain capital adequacy and manage risk, how on earth did they let these bad loans pile up to the point of a systemic crisis? Weren't there alarm bells?
It was a combination of macroeconomic euphoria and a lack of legal discipline.
Euphoria.
Yeah, during the boom period before 2008, there was irrational exuberance. Banks, particularly public sector banks, lent aggressively to heavy infrastructure and highly leveraged corporates.
And then the music stopped.
The global financial crisis hit, followed by domestic economic slowdowns. Corporate revenues collapsed. Cycles of high interest rates increased the debt servicing burden on those companies.
And they just couldn't pay.
No. And global commodity price shocks destroy the repayment capacity of entire sectors like steel and power.
It created what the economic survey famously called the twin balance sheet problem.
Yes. The corporates were over-leveraged and stressed, and the bank's balance sheets were crippled by the bad loans resulting from that stress.
So how do you fix it? You can't just wish the bad debt away.
No, you needed a complete structural overhaul of how bad debt is resolved in India. And that was the Insolvency and Bankruptcy Code, the IBC, introduced in 2016.
Let's explain how the IBC actually works, because the contrast with the old system is stark, and it's a huge part of the syllabus.
Before the IBC, the legal process to recover bad debts was a nightmare. It was a debtor-in-possession regime.
Meaning the people who defaulted were still in charge.
Exactly. Defaulting promoters kept control of their companies and used endless legal loopholes to stall in court for 10, sometimes 15 years.
All the banks got nothing.
The factory would rust, the assets would rot, and the bank recovered pennies on the rupee. The IBC flipped the paradigm to a creditor-in-control mechanism.
What does that look like in practice?
Under the IBC, the moment a corporate borrower defaults, the creditors can take them to the National Company Law Tribunal. The existing board of directors is immediately suspended. An independent insolvency professional takes over the management of the company.
Wow. So the promoters literally lose the keys to their own factory.
They are out. The creditors then have a strict time-bound window, usually 330 days, to either find a new buyer to resolve the stressed asset, or the company is forcibly liquidated.
That is ruthless, but necessary.
It completely changed the credit culture by instilling a genuine fear in promoters that they could lose their companies if they defaulted.
But the IBC process takes time, right? Even 330 days is almost a year. And the banks were bleeding out. They needed life support immediately just to meet regulatory minimums.
Which is why the government had to step in with a massive fiscal intervention. Bank recapitalization. Essentially, yes.
Yeah.
Between 2017 and 2022, the government injected roughly 3.5 lakh crore rupees into public sector banks.
3.5 trillion rupees. That is staggering.
It was the only way to save the banking system. By injecting equity capital, the government repaired the bank's balance sheets, pulling them out of the black hole.
It restored their capital adequacy.
Yes, which finally unclogged the monetary transmission mechanism, allowing them to participate in credit creation again.
Okay, we've covered the architect, the tools, the broken plumbing, the shadows, and the massive blockages.
That's a lot.
It is. But now let's tackle the phenomenon all of this is built to fight. Inflation.
The main enemy.
Right. If you go to a doctor, they use a thermometer. In macroeconomics, we have two primary thermometers, and they often give completely different readings.
We are talking about the Wholesale Price Index, the WPI, and the Consumer Price Index, the CPI.
For your GE-04 exam, you must be able to contrast these deeply, not just define them. So let's do it. First up, WPI.
The WPI captures price changes at the first point of bulk sale, the factory gate, or the wholesale mandi.
Okay.
The current base year is 2011-12. Crucially, the WPI basket covers only goods, manufactured products, primary articles, fuel, and power.
It completely excludes services.
Yes.
So no haircuts, no rent, no healthcare, no education costs.
None of it. Also, WPI excludes all indirect taxes because it is measuring the pure cost of production, not the final retail price.
So who even uses it?
It is heavily used by industry for indexing commercial contracts.
Right.
And because wholesale prices eventually feed into retail prices, WPI is considered a leading indicator. It generally leads CPI by about 3 to 4 weeks.
Okay, contrast that with CPI, which is the thermometer the RBI actually uses to administer medicine.
The CPI captures the retail prices actually paid by consumers.
Yeah.
The RBI anchors its policy to the CPI combined index, which has a base year of 2012.
Combined meaning what?
It takes a weighted average of rural and urban baskets.
And the basket itself is fundamentally different from WPI.
Utterly different. It covers 358 items, And vitally, it includes both goods and services.
So this is where rent and healthcare show up.
Exactly. It captures the cost of housing, education, and medical care. It also includes all indirect taxes like GST because that's what the consumer actually pays out of pocket.
And the weightage within that basket is what causes so much debate in India, right?
This is the critical distinction for your exam. In the Indian CPI basket, food and beverages make up a massive chunk, almost 45.9%.
Nearly half the index is driven by food prices.
Yes.
And just to be comprehensive for the listeners, there are other specific CPIs too, right? Like for specific demographics.
Yes, there's CPI-IW for industrial workers and CPI-AL and RL for agricultural and rural laborers.
What are those used for?
These are highly specific indexes used primarily by the government and corporations for calculating wage revisions and dearness allowances. It compensates specific worker categories for the rising cost of living.
But for macroeconomic monetary policy, CPI combined is the anchor.
Correct.
Okay, here is where I really have to push back. If nearly 50% of the CPI basket is food, and the RBI controls interest rates, aren't they basically fighting a supply chain war with a financial weapon?
It's the classic dilemma.
I mean, how can they justify raising the repo rate when the monsoon fails and onion prices triple? Hiking rates doesn't make it rain. It doesn't fix a broken cold storage supply chain.
It doesn't print more tomatoes.
Right, but what it does do is make borrowing more expensive for an MSME factory trying to expand. Aren't they punishing industrial growth just because of bad weather?
It's an excellent argument, and it represents the fundamental dilemma of Indian monetary policy. You are absolutely right that Indian inflation is heavily driven by cost push factors.
Right, supply side.
A failed monsoon, a spike in global crude oil prices, or the government hiking the minimum support price, the MSP, for wheat. These create supply-side bottlenecks. A repo rate hike does absolutely nothing to fix those structural issues.
So why do they do it? Why pull the lever if it damages growth but doesn't fix the tomatoes?
For two vital reasons. First, they look at core inflation.
Which is what?
That's headline CPI minus the volatile food and fuel components. The RBI wants to ensure that demand pull pressures aren't exacerbating the supply shocks.
Okay.
But second, and much more importantly, they hike rates to anchor inflation expectations.
Walk me through how that justifies the damage to industry.
Imagine onion and fuel prices stay high for a long time due to supply shocks. If the RBI does nothing, people start expecting all prices to rise continually.
So panic sets in.
Workers go to their employers and demand higher wages to compensate for the expensive food. Businesses agree, but then raise the prices of their manufactured goods to cover those higher wage bills.
And suddenly you have a wage price spiral.
Exactly. The inflation becomes generalized across the whole economy, infiltrating the core. By hiking rates, the RBI sends a forceful signal.
They are saying we won't let this spiral.
Yes, they deliberately cool down aggregate demand to break that psychological expectation, preventing the supply shock from permanently infecting the broader economy, even if it causes short-term pain for industry.
It's a brutal trade-off, and historically we've seen these two thermometers, WPI and CPI, tell totally different stories, leading to massive policy confusion.
Oh, absolutely.
Look at the period from 2009 to 2014. Let's do a deep dive into that divergence for the exam.
That was a fascinating period. WPI was remarkably low, sometimes even touching negative territory.
Why?
Because post-financial crisis, global commodity prices, especially metals and industrial inputs, were crashing. So wholesale goods were cheap. If you only looked at WPI, you'd think inflation was dead.
But CPI remained stubbornly high, hovering near double digits.
Because CPI was capturing the reality on the ground that WPI ignored.
Right.
India was seeing massive inflation in the service sector. Healthcare costs were rising, education was getting more expensive, and structurally high food inflation due to changing dietary habits and MSP hikes.
And WPI completely missed all of it.
Completely. This massive divergence is exactly why the Urjit Patel Committee argued that anchoring policy to WPI was flying blind. It was giving a false signal, while the average consumer was drowning in the rising cost of living.
That makes perfect sense. That's why the official shift to CPI combined in 2016 was so critical.
Exactly.
And then we fast forward to 2022, 2023, the Russia-Ukraine shock. This was the ultimate stress test for the flexible inflation targeting framework.
A classic, massive external cost push shock. Crude oil, edible oils, and fertilizer prices exploded globally overnight.
This imported inflation hit India hard.
The RBI had to react aggressively to prevent a generalized spiral. They hiked the repo rate by 250 basis points from 4% to 6.5% in an incredibly short window.
But hiking rates aggressively during a massive supply shock, doesn't that risk stagflation?
It absolutely does. If we visualize the short-run Phillips curve, an adverse supply shock shifts the entire curve outward and to the right.
You suddenly have higher inflation at every single level of unemployment.
Exactly. By hiking rates to fight that imported inflation, the RBI risks compressing aggregate demand so much that economic growth stalls entirely, leading to rising unemployment, while prices remain high from the external supply shock.
It's the worst of both worlds.
The RBI had to walk a very delicate tightrope between taming imported inflation and not choking off the post-pandemic economic recovery.
Okay, there is one more historical episode we have to cover under monetary shocks. It's impossible to talk about Indian monetary economics without discussing November 2016 demonetization.
You have to know this.
Now, for the purposes of this specific GE-04 exam revision, we are treating this strictly as a monetary shock and looking at its mechanical effects on the monetary aggregates and output.
Right. From a purely macroeconomic perspective, withdrawing the 500 and 1,000 rupee notes invalidated roughly 86% of the currency in circulation overnight.
86%. That is an immediate severe contraction of the M3 money supply.
A massive, sudden liquidity vacuum.
How did that transmit through the economy?
It hit both the demand and supply sides simultaneously. On the demand side, household consumption plummeted because people simply didn't have the physical cash to facilitate transactions.
But the supply side channel was arguably more disruptive, right?
Yes. Remember the 40% informal sector we talked about earlier?
Agriculture, MSMEs, daily wage labor.
Exactly. They operated almost entirely on cash. The working capital simply vanished.
Poof. Gone.
MSMEs couldn't pay their raw material suppliers. Farmers couldn't pay daily laborers. The velocity of money collapsed.
So what happens to output?
This severe cash shortage compressed the output multiplier. Production in the informal sector ground to a halt, leading to a significant short-term loss in GDP growth and severe short-term job displacement.
But what about the medium-term structural outcomes? Did it change the plumbing?
The medium-term macroeconomic outcome was a forced formalization of the economy. Because physical cash was squeezed, it acted as a massive catalyst for digital payments.
The UPI ecosystem exploded precisely because of this vacuum.
Exactly. And by forcing cash deposits into banks, it expanded the formal tax net, setting the stage for the GST rollout the following year.
So it's a severe short-term output shock traded for medium-term structural formalization and digitization of the payment plumbing.
That's the exact phrasing you want to use.
All right. We have covered incredible ground today. We've mapped the evolution of the RBI, the monetary aggregates, the toolkit, the broken transmission pipes, the shadows, the blockages, and the twin thermometers of inflation.
It's a comprehensive overview.
Now let's bring it all together for you, the listener. You are staring down the barrel of the 2026 GE-04 exam. Based on the massive stack of sources we've analyzed, here is our synthesis of the 3 most likely exam patterns you need to be ready to execute on.
Okay, pattern number 1, RBI monetary transmission channels and their limitations. Do not just list the channels.
You must be able to critically explain the friction.
Yes. Focus on the 6 to 8 month lag due to sticky deposit rates. Explain how the 40% informal credit market acts as a complete bypass using the local moneylender example.
And don't forget the liquidity trap, where risk-averse banks refuse to lower MCLR rates even when the repo drops.
Pattern number 2, the NPA crisis. You need to connect the macroeconomic causes, the twin balance sheet problem, economic slowdowns, commodity shocks, to the erosion of bank capital.
And for the resolution, you must contrast the old debtor-in-possession system with the new creditor-in-control IBC of 2016.
Right. Highlight how the IBC changed credit discipline and how the massive government recapitalization unclogged the credit multiplier.
And finally, pattern number 3, the WPI versus CPI comparison. This is a classic.
Detail the basket composition differences, especially the total exclusion of services from WPI and the massive 46% food weightage in CPI.
Explain the tax treatment differences, too, and use the 2009-2014 divergence as your historical case study.
Yes, use that to explain why the RBI officially anchored to CPI, combined under the flexible inflation targeting framework to capture the true cost of living.
We promised you a shortcut to being well-informed, and hopefully we've delivered. But before we sign off, we want to leave you with one final provocative thought.
Something that isn't explicitly in the historical PYQs yet, but represents the absolute frontier of Indian monetary economics.
What is
We spent this entire deep dive analyzing the plumbing, the commercial banks, the NBFCs, the transmission lags, the friction of getting M0 to become M3.
Right.
But consider this. The RBI is currently piloting the central bank digital currency, the CBDC or e-rupee.
Okay, yeah.
Now imagine a near-future scenario where the government integrates the e-rupee with the public distribution system or agricultural subsidies.
Wait, meaning the RBI could issue programmable, high-powered money directly into the digital wallets of citizens?
Exactly, bypassing the commercial banks entirely.
Oh, wow.
If the central bank can inject or absorb liquidity directly at the retail level, how will that entirely rewrite the traditional money multiplier?
It changes everything.
If they can execute direct, instantaneous monetary policy to a farmer's phone in Uttar Pradesh, do the current sticky banking transmission channels we just spent an hour analyzing even matter anymore?
It's a fundamental paradigm shift in how we define the monetary transmission mechanism.
It really is.
Now that is an X-ray that looks completely different. Good luck on the GE-04 paper. You've got this.